Morning, everyone. Thank you so much. Revenue-based financing, while relatively a new concept in India, has been around since the 90s. With I think Arthur Fox introduced it, in the US. Today on our panel, we have three members who are innovating with this alternate financing category in India. Welcome, Ishita, Ashish, and Bhavik. Really privileged to have all three of you on this panel. Ishita, let me start off with you. For the uninitiated, can you help us understand what exactly is revenue-based funding?
Thanks, Ashish. Thanks for having me. So revenue-based financing, as the introduction said, is a very flexible, founder-friendly, and fair way of thinking about capital. I'll go through the basics of how the financial model works, and then talk a little bit about, how it's evolving and why you're hearing a lot more about it recently. So revenue-based financing essentially is that a startup or a regular company which has certain revenues and wants to raise capital to make certain, say, revenue generating expenses or capex, avails this financing and essentially repays it as a percentage of their revenue over a pre-agreed amount or a pre-agreed percentage over a period. So it's as simple as that. It's different from debt in a way that there are no fixed EMIs or personal guarantees or collateral obligations or anything of that sort. It's different from equity in a way that the founder undergoes no equity dilution. They don't have to part with board seats or generally lose control over their business. So it's somewhat of a sweet middle ground. It provides flexibility in a month that revenues are lower. Essentially, repayments can be lower. In a month when revenues are higher, they can afford to pay more, so they pay more. And, the risks and rewards are mirrored. Typically, the companies we fund, and I'm sure most of my colleagues in the industry here fund, raise revenue-based financing for a few use cases. The most prominent ones being inventory. Your digital business, say, one of our companies that we fund is a company called Very Large. They sell fashion wear on Myntra. They need inventory financing. This is a great use case for revenue-based financing. Similarly, one of our customers is a company called EatFit. They have cloud kitchens. Every time they expand cloud kitchens, they need to make revenue-generating capex. So that's another great use case. Similarly, performance marketing is the third and most prominent use case. We have a D2C fashion wear brand called Babyproof, which recently used influencer marketing expending as revenue-based financing. So that's just what the product is. Under the hood, and these are themes I believe we cover, so I'm not going to expand on them, but why is it getting so much attention, right? Like that's the next answer. I think revenue-based financing, has emerged as a complementary format that bridges some of the gaps between traditional equity and traditional debt. Somewhere in the middle, takes care of issues that face. So we think of it as an and equation and not an or equation. We're not here to replace that. We're here to fill the gaps which is not getting filled. The second thing is that it's also an entirely new way of thinking about assessing a business for capital. So we are extremely tech and data first. We focus on looking at what are the data footprints that exist in the business that give me feedback on quality and quantity of revenues. And how can I use that to deploy capital instead of, looking at the balance sheet or looking at what collateral I have. So it's an entirely different capital deployment paradigm as well.
Just to add to that, and I think Ishita has summed it up well, but I think the most amazing way to put this is we call it performance-based funding. And I think that's where, unlike traditional equity funding, it's not about a human bias and who you know, nor like traditional debt where you have to have some physical collateral and asset. And I think that's where truly assessing a business by its performance and being able to give it access to capital, this is what revenue-based financing is doing, purely a revenue-based and a performance-based model.
Hey, thanks so much for that. Bhavik, I want to kind of hang on to that thought and direct my next question to you. But before I go in there, you also I think you just closed your fundraise as of yesterday. So if you could just tell our audience about that and then touch upon what is the need in the current Indian economy for revenue-based finance, right? I mean, how do you see that market opportunity? If you could just touch upon that point as well.
Sure, Surjit. Thank you for the compliments again. And like I said, and my colleagues will resonate with me, we are in the business of further backing more and more businesses. So all the capital that we raise is dry powder. We've just announced a $36 million round as of yesterday, led by Chirate Ventures and Verenium and DMI. And this is just more fuel on our mission to back more and more founders and entrepreneurs with the capital and the growth capital boosters that they need. And I think that very well, Surajit, dovetails into the question you asked me, right? What's the need of the hour, right? And I think if we were all to take a step back, and for everybody that's listening in, it's important to really cite two trends in the Indian economy. If you look at the last decade that went by, we saw commerce going digital, right? It was the year where travel went online. You had the Amazon, Flipkart, marketplaces kind of take front and center. And then 2016, post demonetization, we saw money also going digital. And therein we see this very large consumer behavior shift. Today, I think more than any time else, and in the last 2 years of the pandemic, we've just seen this acceleration where the consumer is now buying and spending everything that much more digitally and online. So if consumption is going more online, and India largely always being a small business economy, and I think I really like to say that at GetVantage, we're not funding startups, we're really funding small businesses that are going online. And I think that's the need of the hour for every small business now. And these are small businesses that are going online, reaching the consumers more digitally, engaging with them more digitally, taking their revenues that much more digitally. And I think therein it requires this huge need. And I'll give you some data points. The acceleration that has seen is today we have about 8 to 9 million small businesses that are digitized and have digital revenues in some shape or form. But as they're growing more and more online, they're growing in a new way, right? What we want to also be able to recognize is that businesses are fundamentally changing the way they operate. Gone are the days of setting up factories and having collaterals. These are all digital and asset-light businesses that are coming up. And hence, with consumption going online, businesses going online, these small merchants and now trying to reach its consumers far more digitally. That's where the need for India to also have a far more digital and a performance and a cash flow based, a revenue based model of funding and financing. And I think there in it, we've seen this need that this decade and the decades coming forward, we're going to see more and more local brands. I think we've seen the government, the PM talking about local brands. I think all of us are now buying local brands, be it in apparels, be it in our coffee, be it in our daily utility items. So with more and more local brands being able to now literally set up and start from their kitchens. Ishita mentioned about a few brands. We can name so many brands like the Rage Coffees of the world or pet care brands. These are brands starting literally from kitchens and drawing rooms of husband and wife couples, digital asset-light businesses, small businesses. And I think that's the gap and the need that needs this alternative form of capital.
Thank you so much, Bhavik. And hang on to that thought. I'm going to come back on this, digitization of small businesses subsequently. But Ashish, before we, get into the nitty-gritties, of revenue-based funding, I just, Ishita touched upon it, but if you could just make the distinction between, say, debt, the traditional debt which has been available, and equity financing which has been available, right? Where does revenue financing really sit? What are the, if I am trying to raise capital through this route, right? What are the benefits of opting for this particular route rather than equity or say debt?
Sure. First of all, thanks for having me, Surjit. It's a pleasure to be on this panel. Coming back to what Bhavik and Ishita mentioned, one of the things I want to take a step back and talk about what we do at N+1 is, of course, we are backing digital businesses like Bhavik mentioned, but I think there's also room to come in with this flexibility for a little bit of traditional MSMEs as well. And I think that is going to fuel the growth of the economy. Just to take a point of view on what has been happening is there's been a lot of innovation at the entrepreneurs, right? You're seeing new age business models coming up, but capital at its end has fairly remained traditional. And that's the reason you see emergence of businesses like ours, wherein the whole concept of giving investments or debt capital is flipped on its head. Now, coming to your question on differences between traditional forms of capital and RBF, I think four major reasons, right? Between, say, a bank, NBFC, venture debt, and an RBF. Now, think of it from a credit underwriting perspective. How do these four entities actually take a decision to make an investment? A bank, Surojit, or an NBFC typically will rely on a business's fixed assets or the personal guarantee of the promoters or personal assets. So you've got a house worth 10 crores. I'm going to give you a loan worth 6.5 crores because your house is a collateral, right? The business has plant and machinery. We'll give you, say, 60% loan to value of that plant and machinery. What does a venture debt player typically do? They're going to draw comfort for investment largely based on the fact that who's the equity investor on the cap table. Is there a large Sequoia sitting on the cap table? Is there Matrix in case the company falters? We know we've got a large equity investor who's going to make sure the company survives. RBF is probably a new asset class, which is the only one which is taking a bet on the business's ability to generate cash flows to repay its own obligations. And that's what makes it founder friendly, right? Everyone has skin in the game, including us. We're not relying on anything else besides the business to pay us. That's number one. So credit underwriting. Number two would be the repayment flexibility. Now you take the other three asset classes like a traditional debt, bank, NBFC, or a venture debt. You've got a fixed payout every month, which has no correlation to how the business is performing. And today, all of us know that every business is cyclical in nature. You cannot predict exactly how much revenue or cash flow the business will generate. What does RBF do in that case is our repayments from a borrower's perspective mirrors his own business performance. So if he sees a dip in a particular month or quarter, his payout to us will dip. If he sees an uptake, there will be a larger payout. So it builds in that flexibility from a borrower's perspective. The number three bucket is speed. And trust me, this is not spoken about enough. Speed of deployment of capital is so often the differentiator between a business growing at 10% versus 25%, right? I mean, we as RBF providers can invest capital in about maybe 5 weeks. Bank could typically take maybe about 3 to 4 months because they have the internal processes. Venture debt possibly could take, I'm thinking about 2 months because they've got an equity component. And the fourth and the most important thing that we all should consider as industry people is how do we measure the success of all of these asset classes? A traditional bank would only be concerned with saying, I want my money on time. That is the success of my account. There should be zero delays, zero a difference in payments. A venture debt player would say, I want the maximum outcome on my equity wallets. That would be the measure of my success. For us at N+1, the measure of success is when my portfolio company is strong enough to go and raise more capital from these traditional sources of finance, like a banker or an NBFC or a VC or PE. That to me is a measure of success. So these are the four broad buckets I would say kind of differentiate us. And I echo Ishita's thought. We're not competing with any of these guys. We're all complementary to each other because every business needs all kind of capital through its life cycle. And RBF sits through from an early stage to all the way up to late stage. We've got companies in our portfolio, Surojit, which are doing as low as say 15 crores per annum, all the way up to 450 crores per annum. So you can imagine, I mean, the variety that we can cater to.
Right. And Ashish, that leads me to ask you, so when you say that you've got variety right from 15 to 450 odd crores, right? So at what stage should basically a company, maybe an entrepreneur or a traditional business trying to modernize itself, at what stage do they essentially look at revenue-based financing as a source of capital?
So see, there's a couple of options right there, Surojit. One is, of course, imagine a business already has a working capital limit or an overdraft facility from a bank. but the bank could only give them X percentage because of the collateral that the guy could provide, the business could provide. Then when they see, think of it as a Diwali season is coming up for a large direct-to-consumer brand, and they need to invest money in working capital to procure more inventory, but the bank has capped the limits. Boom, that's where you enter in with RBF, saying that, listen, I need money in 4 weeks. I know there's a huge Diwali pre-orders coming up. I need, X plus 10, or whatever it is. Can you please come in and fill in that amount that we need, right? The second kind of businesses are wherein business is just growing regularly at its own pace. There is no season, there is no expected season, but the business wants to raise capital to kind of hire a team, wants to build out a tech platform, and general growth purposes. So there's one is working capital, second is growth capital. These two, to my mind, cover at any point in time when the business needs to raise money, can they come to players like all of us?
Another way, Surajit, to add to Ashish's point, and just, to make this more easily understandable, we keep getting asked this question, is this for very young companies and early startups? Let's break that myth, right, for everyone listening in. We've backed businesses that are even Series B and Series C funded already, are doing monthly revenues upwards of 5 crores, 10 crores a month in terms of MRR. Because to Ashish's point, what this is really looked at is, I as a business need different forms of capital. I've raised equity, I've raised some long-term debt for capex expenses, but look, whatever I need capital for pattern-driven growth, right? Whether it's my digital marketing, whether it's a spike in seasonal spend, seasonal inventory, or even interestingly, a bridge round before I go for my next round of funding, right? All of these are leading to one simple goal and milestone every business today needs to achieve, which is growth in their monthly revenue run rates, growth in their ARRs, right? And I think that's absolutely the use case where RBF comes in, gives that booster capital. And why only product companies? Let's talk about very briefly B2B SaaS businesses, right? To give you all a flavor of, we have a 25-30% portfolio of our brands that are B2B SaaS businesses. And while they have taken in annual contracts or they have annual subscriptions coming in from more users that they've onboarded, but they need capital to increase their infrastructure, their cloud hosting today. So they need some capital advance today to raise their infrastructure while they know they're going to recognize revenue for it over the next course of 8 to 12 months. And I think for all of these, no matter what stage or scale the business is, RBF can really play that role of filling in that short-term requirement for booster and growth capital.
Right. Bhavik, so great points. But as a follow-up, what I wanted to ask you is is it that you see RBF as a use case for just the short-term capital needs of the enterprise, or is there a play even as an alternative to, or say, a sliver on top of long-term debt or equity?
Look, the most simplified way of really talking about RBF is it's nothing but cash flow based funding. Mm-hmm. Right? I think the flexibility, whether it's short term or long term, and I think every business rightly needs to evaluate what type of capital at what phase of their journey do they need access to. This is truly cash flow based funding. And if a business has a good understanding of what their cash flows are, revenue based financing literally is so much a more flexible, so much a more business friendly way of raising capital, because the flexibility is, it's unlike traditional debt, right? There is no monthly EMI, right? There's no fixed amount that they have to pay every month, irrespective of how the business does. I think that's one of the biggest validations that all of us have got from founders and businesses we funded. And the reason this has really picked up and sat really well with business owners and founders is this is truly based and dependent on how their businesses perform month on month, right? And I'm paying a sliver, or I'm paying a small percentage of as my cash flow comes in. So I think the question really is not whether this is a long-term or a short-term requirement. I think this is for businesses themselves to first really recognize that, look, we all are under the assumption that equity is a form of capital you don't have to return, but that's a myth. It's the most expensive form of capital. I think we all know. We have to, as founders, pay back a lot more if you do the real IRR math on equity capital raise. And number two, even if you're looking at short-term seasonal capital or slightly longer-term growth capital, I think if you have a good pattern and revenue and performance trajectory and cash flow trajectory, I think that's where RBF sits, and what tenures, what quantums, what percentage of your revenues and cash flows are you willing to pay? And I think therein, I wanted to be able to highlight that the ability that we have as advantage in the tech-driven, I think what we have not touched upon is the importance of the technology interventions that we've been able to do for these businesses, because now you're able to now flexibly, it's not like a traditional bank debt as well, Surajit, where it's a one-size-fits-all product, right? Whether I'm a company that does X or a Y revenue, my interest rates are the same, right? Or my EMI is fixed for 12 months, 15 months, 24 months. What our technology intervention is able to do is not only be able to price in a more personalized way based on how the business is, but also the revenue shares, or also align the repayments to the margins the business can afford. And an example for this is that probably an apparel business has a good, healthy margin per product and can shell out a higher percentage as repayment, but needs longer tenure and a shorter fee or a smaller fee amount. However, a more general utility item business will have much smaller revenues or margins. And so the rev share has to be low. And so to be able to configure and customize this is where the ability of the platform and technology really plays a strong role, that each business is getting the capital for the tenures, for the rev shares, that they can really align and tune to their own business and their category that they are playing in.
I just try to answer that, just top up a little bit what Bhavik said. To your point, Surajit, on whether it's short-term, long-term, can it be a tradition? Can RBF become traditional? Definitely, right? Today, we're starting off small. So we're a $100 million fund. We see this asset class becoming $1 billion in the next 5 to 7 years. To businesses, from a borrower's perspective, I think this can be a good short and long-term kind of form of capital, right? So typically, you can lend for as low as 12 months. You can lend as high as 36 months. But the core differentiator for RBF is the continuous supply of capital for borrowers. So assuming somebody's entered one of our folds as a borrower, he's borrowed for say 15 months in the beginning, and 10 months down the line, he realizes there's a massive uptake coming in revenue. He needs another line. It'll literally take us 7 days to pump in the next round because we already know the borrower well, right? So think of us as somebody who can do both short-term, medium-term, long-term providers of capital up to at least 36 months, and a continuous form of provider of capital. That is core for any business, because a business life cycle is just lending. Yeah.
Right, almost making capital ubiquitous for the startup ecosystem and also the traditional businesses, right? Let me get Ishita into the discussion. Ishita, I think both Ashish and Bhavik touched upon speed, right? And one of the ways you achieve speed is through highly leveraging on technology. So how different is risk underwriting, collections technology in RBF, and how are you solving for these aspects?
That's a great one, and I feel like that's the secret sauce why RBF has managed to scale and innovate so much over the last few years. So the short answer is we're completely data and technology first. There is very limited to no physical documentation intervention. So just to give you a sense of how does data and technology improve customer experience as well as risk mitigation across the stages of a borrower's journey, let me talk about how it looks like at Klub, and I'm pretty sure it's reasonably similar for my colleagues. First thing is, how do you even get the data you want to underwrite, right? Like, how do you start looking at information? In traditional landscapes, in a venture capital firm or in a bank debt scenario, you're either meeting and making presentations, or in a bank, that scenario, you're probably doing mountains of paperwork, and the timelines that Ashish highlighted could run into months. Here, what we are doing is we are saying you run a business already. You have all of this rich data footprint available. We know, how much you're making with your customers, what's your sort of margins like, how much orders are they returning, what are you collecting from every source. This is extremely strong data footprint. And because we're underwriting cash flows and because we're underwriting underlying revenues, we underwrite this first. So we look at data and granularity. What is the quantity of revenues and cash flows? What is the quality of revenue and cash flows? And we do this in a way, there's a natural trade-off in capital businesses between how much you can underwrite and customer experience. Right? You can keep doing this. So to mitigate the customer experience impact for looking at data in such granularity, what we've done is build extremely robust integrations with about 40 plus revenue sources that exist in the country, and say, hey, single click, come to our app, apply. We're going to pull out the information we need. Okay, you need GSTs? Sure. You need Amazon, whatever, right? That makes this a completely new way of thinking about how am I collecting information from the company that seeks capital while making it painless for them, but getting what I need. The second step is how do we assess this? So instead of looking at very strong like balance sheet or collateral led metrics, what we look at is, and I think Bhavik touched upon this, how do we think about these cash flows that the company is getting? How long are they likely to sustain? What can this customer afford to repay based on their margins, their cyclicality, their seasonality cycles? When do they break even on this expense? And look at all of these paradigms and figure out what's a right way to risk. So this is a chalk and cheese from what happens in the world today. Asset-light businesses which have, very different styles of margins do not get underwritten properly because there is an all-size-fits-all underwriting that happens. So the seamlessness, the granularity of data, the seamlessness of getting it from the customer while ensuring a strong customer experience is the three levers that data and tech allows us to pull. Similarly, because of the repeatable nature of RBF in general, which Ashish touched upon, it's not only important for us to look at them the first time well. It's important for us to have a check on ongoing health because we want to be, their first port of call when they need more capital for more inventory. They're doing well. So how do we retain the connections we have with the data of the underlying business and use it to make sure that if in 7 days, 10 days, 15 days, 2 months, 3 months, they want more capital for the next festive sales season or the next capex expansion cycle, we already know the borrowers so well. We already know the startup or the company, their businesses so well that repeatability is a big part of how we can add value by data and tech. So they don't have to go through even the first element of the journey the second time or the third time they come to us, and making sure that this is something that they can rely on, that if I have to use the performance-based terminology, if they're performing well, this is a source of capital they can rely on. So using it for monitoring, using it for predicting good behavior, using it for early warning signals so that our capital providers are always aware of early warning signals on anything that might be going wrong in a portfolio. That's another thing we do well. And the core of this is an extremely strong sort of technology infrastructure that we've built over, say, 3 years, where we can talk to 40 or 50 different systems to get this analysis available at a very high level of granularity.
Right. Ashish, Ishita just spoke about a lot of usage of data, right? And that is in the underwriting process. But post lending, post your disbursal, right? I mean, what is the role that technology is currently playing in terms of your monitoring, and also is there a role for collections technology in RBF, or is it more like equity where you're kind of just tied yourself to the performance of the company?
Yeah. No, I think Ishita touched upon some great points. So, Rajit, so your point on monitoring and collections. Definitely, right? I mean, if we want to scale up this asset class to a billion plus, we cannot do it without using technology. So on the collection piece, right, there are newer and newer forms of collecting, which moves the onus of repayment from the company to us as investors, wherein what happens is it's almost like you can pull the money out of the company's account, which is pre-agreed, without the company having to make a manual transfer. For instance, we use something known as NACH mandate. It's almost like an electronic PDC, which says we inform the company 3-4 days before that, listen, you need to maintain X amount of balance in your account, which you can then, which we will then just debit from their current account. That's one form on the collection. There are many other forms which some of my colleagues would be using, which is direct gateway, payment gateway integration, POS integration, wherein on a real-time basis, on every credit, a percentage of revenue goes to the account of the lender. On the monitoring piece is where actually I'm very excited, and this is something we discussed earlier, that there is a concept known as account aggregator, which is coming up, and I think Bhavik had brought this up when we were preparing for this, but the account aggregator concept right now is not live for borrowers, Surajit, but that's going to be a massive differentiator, right? In the lending business, what's most important is periodic monitoring. What that allows us, what do we monitor? We have to monitor the company's GST returns, the company's bank statements, and the company's MIS. These are the three prime data sources we rely on to monitor the health of the portfolio. But it's cumbersome for the company to send this information every month or every quarter. What is the account aggregator going to do when it goes live? Is that we as lenders will take a one-time approval from the borrower so that we have real-time access to their GST returns, to their bank statements, and the company only has to share their MIS. We will then feed it into a software which we have at the back end, which will then triangulate all of these three data sources, which says that, listen, if the company is reporting 5 crores of revenue in the previous month, does it correlate to the GST collections? Does it correlate to the bank statement? We then know what is the right question to ask. This actually is not only from our perspective, it actually helps the promoter see where there are gaps in the business. So right now we're doing this manually, but we're very excited about this upcoming technology.
Yeah, I actually have a sort of fairly interesting anecdote on this respect, Shirajit, and this is to the point that Ashish mentioned that it helps the company. We collect directly from payment gateway and marketplaces and logistics platforms and COD platforms, and our systems are more robust than a medium-sized companies, right? So fluctuations in revenue, fluctuations in not settling, all of these we spot at a higher frequency than a, say, poorly staffed finance team of a company. We've had 2 instances where we told the company, hey, your payment gateway hasn't settled in 2 days. Is everything all right? And they went back and they realized that they were having massive issues. And they still date, like, so thankful to us for sort of being vigilant on their behalf. So not only, the use case for the capital provider is obvious. You're getting high quality daily data. You're collecting cash at a high frequency, which is, so it's a reducing risk product, but at a daily level for the capital provider. But the use case for the customer, where, being able to present the robust analytics on, hey, these are the revenues that came, there's a disruption, automatic anomaly detection, auto RCAs on those anomalies. These are technologies that we've built that actually help both sides of the system we're building.
We famously call this, Surajit, what Ishita was mentioning is, we famously call this, like TDS, we call it collections deducted at source, right? So our ability to tap into as the business is getting its revenues, right? And I think from a risk mitigation perspective, right, for everybody who's listening in and is from a core finance and financing and lending background, if we solve for collections in a much more high frequency in an auto way, right? I think you're already de-risking the model by 50%, if not more. And touching upon a little bit about data and live monitoring, Surajit, that you asked, we actually call our platform something like a live ECG machine, right? So we've connected not only at application, but through the assessment, we've connected through APIs live into the business. And it's just like the ECG machine, right? We are seeing the patterns of their business, their revenues on a daily basis, right? So even post disbursement through the tenure of repayments, the ability to really monitor the health of the business, how are their revenues? How are they shaping up? Is there anything off pattern than what it was prior, right? And so even though there is always risk in any financing and funding business, our ability to take corrective measure is literally in real time. And that's why we say that data and live monitoring is the new collateral. Gone are the days of the perceived value of physical collateral in SME lending. This data and live monitoring is the new collateral.
Absolutely, Bhavik, and not to mention the IRR point of it when you start collecting from day one, right? Absolutely fantastic. Very interesting in the sense that it almost appears that you're marrying the best in class of VC and best in class of debt from the entrepreneur and the founder's point of view, right? So I'm going to move away from just a capital-based question to some of the additional supporting infrastructure. For example, if you were to look at venture capital, right? It is not just the capital, but also a lot of ecosystem benefits that a portfolio generates, right? Is that also something that you're building within your companies and your portfolios?
I'll take that first.
Maybe if you could take that, yeah.
I'll take that first, and absolutely, Srijit, that's literally, the genesis of our name as GetVantage is giving that added advantage to every small brand founder and business, right? Capital is what we believe is just the first step that a business needs, but being able to provide them with further support, intelligence, efficiency, better performance marketing, bringing a complete kitty of ecosystem partners that really help them grow their business. And I think that's where this is a win-win or a skin in the game model, right? It's in both benefits. Here, the business is focused on growing to its next milestone of revenue. And yes, we're all in the business of profitability. And if the business gets to its next milestone of revenue, so does our collections grow up that much faster, right? And I think that's where the sweet spot of really being a really win-win model. And for us as GetVantage also to be truly calling ourselves more a founders platform, where we are able to provide them with the capital plus those intelligence, efficiencies, and all the tools that they need to get from X to 2X of revenue on a month-on-month basis.
Yeah, and I think Shurujit, just to add to that, right, while the community and ecosystem impact of it is important, we've tried to bring that a little bit into product innovation as well. So because we have hyper-specialized use cases that we're funding, we're able to partner with experts in those use cases. So for example, if you want to do an influencer marketing campaign or a inventory campaign, right, there are service providers that these companies are already working with. There are a few that are really good. Marrying the whole idea that making this advantage available to them, as well as using that as in risk and using that in rethinking product, that hey, how does, if these are the top 3 performance marketing firms and these are the companies that are looking at performance marketing financing, how can we create a product that is seamless for the customer, but where the risk mitigation is actually provided by additional insights from the actual tier 1 service provider that is going to guarantee those outcomes. Hey, in the earlier paradigm, you're funding a company, you're trusting them to do marketing well, right? And here you suddenly have this advantage that, hey, not only can I deploy this capital, I can control the use case, I can probably channel it better so that there is decent ROI and there's an additional layer of risk protection. So I think it weaves into product innovation as well.
For us, Surojit, on what value add we can provide beyond just capital, since we are a fund, a category 2 AI, we think about it slightly in a different manner because we kind of play the role of a board member without actually taking a board seat in any form, right? And what that means is our team, our board of advisors are available to founders as they think about operational challenges, as they think about growth challenges, as they think about strategic challenges. So what that means is, so for instance, out of a portfolio of about 30 odd companies so far, already we make it a point that founders speak to each other. There's a lot of value that a cross-sell within the portfolio can bring to multiple founders, right? When people are looking to hire people today, we get founder calls all the time saying that we're looking for such people. Do you know folks? And that's wherein, we tap into our network, our advisors network, to say that, listen, great company, they're looking to hire people. The other most important benefit is, since we have investors who are family offices from around the world, large corporates, They sometimes pick companies who are aligned to their core business interests, and then they become business development opportunities for those founders. So, for instance, one of our investors who's in a particular domain was very keen to work with one of our companies because they had a solution which made complete sense. So then the portfolio company just ended up signing a huge order from one of our investors. And I think some of these benefits are very intangible, but very, very value accretive to the business. And that's something we pride ourselves on. But we make sure we're never intrusive to the founder. And I think that's very important, where you want to come in as flexible, pay as you're able or debt providers. You don't want to be able to breathe down the founder's neck. And that's something which is in our ethos, that we're here to support you whenever you need beyond capital, and we're just a phone call away. So that's sort of the way we think about it.
Absolutely, Ashish. I think you hit the nail on the head in the sense when you said, you're not intrusive to founders. But quickly, a leading question to that. Is there a point where it is too early to take out cash flows from a company? Do you see it like that?
No, so Surajit, it depends on what kind of companies you go after. So for us, our ticket sizes of investment up from 2 crores to 15 crores. So for a qualifying company, the minimum MRR or a monthly revenue has to be 1 crore and above. What we think about there is, it's not about how early you are. It's about what are the obligations the company already has at that point in time, right? A company could be doing 1 crore a month, 5 crores a month, 10 crores a month. But it doesn't mean a 10 crore company is the right company to lend to. What if it has monthly obligations which its cash flows can't support? It's all driven by the company's monthly obligations, right? Can the cash flows support it? Do we as investors think that the company will grow with our capital and be able to service back the additional obligation that they have? And that's the magic sauce. And that's why you need to come in with a view that what is the future that the future of the company is the predicting of the future is what we're into. Honestly, that's the core business, which we just can't rely based on history. We have to take a forward-looking view. So company could be doing 10 crores, 15 crores a month, but doesn't mean that it's the right candidate. We have to analyze on a cash flow basis. For us, the qualifying criteria is about minimum of about 1 crore a month. And we don't think it's too early.
Yeah.
Right.
And I think we've taken a more platform approach to this problem as well. So what Ashish is saying is very valid, that you have to look at obligations and decide how much you can fund. But what we've also seen is different capital types behave differently. So, Ashish represents a fund. We operate like a platform where we have our own fund, but we work with NBFC partners being a large source of capital for us, as well as HNIs and LPs, right? So we've seen that all of these capital sources behave differently. So our check sizes are ultimately much wider. So we do everything from say 3 lakhs to 30 crores today. And we've tried to marry the check size journey and the vintage or the scale of the business journey with the right capital that can support this journey. So what ends up happening is that, there are NBFCs who are more than happy to write 3 to 5 lakh checks for businesses who say less than 6 months of vintage. And then there are these large, heavy check writers who come as LPs in our fund, and they want to deploy capital in mature Series D plus companies, maybe, sort of Sunicorns, etc., and they want to write $3 to $4 million checks. So having this approach has allowed us to bridge the gap. Of course, the original point still stands, that is there a space where, it's too early? We've typically seen that any business that doesn't have any operating vintage for maybe even 6 months, which you would theoretically call, hey, not great PMF, so 3 months, 4 months, something like that, at least the minimum needs to be demonstrated, and some stability in quality and quantity of revenues, right? So you've been doing this for a few months and you've hit a certain, there's a pattern that my data and technology systems can recognize. There's an established pattern which is not fluctuating month on month. So we start getting in really early. Of course, the amounts, the tenures, and the quantums all are a function of the stage and cycle of the business.
All right. We've spoken about the...
Sorry, to just close up on that loop, I think for the audience, it will be very apt to really also take away this one interesting point, which is for us also as a fintech and as a platform, what really all our large NBFC and funding partners really like and appreciate is we're able to bring new to credit businesses. To Ashish's points, in fact, a lot of businesses we are bringing, they don't have access to traditional debt. And so they are actually debt free and don't have a lot of other obligations. And two, these are also businesses because they have built certain patterns of their business on marketplaces. Say they were sellers on Amazon first. They are also used to and really appreciate and understand that they do know that they pay a small percentage as a trade commission or a platform fee to those marketplaces. So that's how they really look at this, saying, now that I'm able to get capital and get more customers in my own store online or my own captive channels, it's actually a small fee that I'm paying as repayment, which I would anyways have traditionally played on a marketplace. So new to credit, new to debt businesses really just growing and a high growth and already understand what that rev share model works like.
Hey, great insights, Bhavik. We have time for one last one, and I want to direct that to you, Ishita, as a woman entrepreneur. Can you reflect on your journey and share some of the learnings that you have had in that kind of trying to create a category itself in alternate finance?
Sure. So I think there are a lot of women fintech entrepreneurs. I don't feel like I'm a part of a sort of small minority, and I think some of that growth that has happened with more diversity in the ecosystem and founder representation, I go back to my career journey. Before starting Klub, I've spent like a decade in the banking and advisory industry, and trust me, there are more fintech female entrepreneurs today than there were investment bankers in 2010. So I think it has been helpful to think about this from at least from now. I don't want to talk about the challenges and all because everybody does that. I think the role I think somebody like me can play today is provide aspiration, right? Like aspiration is missing. You don't see, when I was joining as an investment banker, there weren't women on my desk. When I was doing work as a trader, there weren't women on my desk. It was an extremely testosterone-dominated environment. It doesn't naturally build aspiration. You don't think, hey, I can be the head of trading or I can be the head of investment banking. It was incredibly helpful. For example, Falguni Nayak, who's now the founder of FICA, she was one of my first super bosses at Kotak. And just having her there, sort of when I was working at HSBC, just having, Ms. Kidwai there and all of that. These are things that go a long way with, and I feel like the landscape as it stands today, I'm so glad for all of my sort of women colleagues out there who are starting businesses, building products whose vision they trust. And I think if I had one takeaway for like people here, I think the journey gets more interesting the more people you help go on the same journey. Like if I didn't have role models, being a role model is one easy way, but just improving diversity in my own team, right? Like we have a very, very diverse team with a lot of women leaders at the senior levels. And I think that is sort of one, I would say, highlight of my journey has been that how do we, not only sort of help the change, but embody the change, lead the change in this. I would also say the ecosystem has been really supportive. I do not definitely believe I've had any different experiences than my male colleagues here in terms of fundraising or customers, etc. I think everybody's been extremely, I guess meritocratic or looking at the vision and idea when dealing with us. So it's, I'm glad that, after like 11 years of working, I can finally say that it's not the major issue that I face at work today.
All right. Thank you so much, Ishita, Ashish, and Bhavik. On that note, we'll wind down the panel. It was a pleasure talking to you, and I hope the audience really enjoyed this. Thank you so much.
Thank you.
Thanks for having us.
Thank you. Thank you.